Okay. Well, good evening. And we are going to start tonight with 4 lessons about life, 5 lessons about the markets. 4 lessons about life. Number one, count your blessings. There is so much in our lives to be grateful for. Number two, cherish your most important relationships. They're what truly matter, and especially when the road gets rocky. Number three, when you think of something positive about someone, tell them right away. It might be exactly what they need to hear today. And number four, experiences what you get when you didn't get what you wanted. So now let's talk about 5 lessons about markets. First one, markets can keep falling for a lot longer than we'd like. I feel like this is the reason Jamie wanted me to give this presentation. Number two, and this is one that's very interesting to me, market bottoms don't come with an all clear signal. And missing the best days of the market can really shockingly damage long-term growth. Number three, don't panic and make sudden decisions. One bad decision can destroy years of good ones. Number four, stocks historically deliver strong growth over time, but you only benefit from it if you can withstand the painful periods that come with that territory. And number five, you can't avoid all risks. You can identify them, manage them, and focus on what is in your control. I'm Jim Dunlop, and I'm one of the managing partners. And this is a tradition that's been I've been partners for a number of years, just getting together quarterly with our clients and just kind of sharing some insight on the markets. This tends to be a very data-heavy presentation, and our job is to deliver a lot of information to you. It can be very overwhelming. I know yesterday's session, somebody asked, could I get a copy of these slides? Tonight's presentation is being recorded and will be put on our website, so that I encourage people to go back and review if there's something you want to see. If I turn on the television, there's a lot of data and a lot of people drawing a lot of conclusions about a lot of data. And I shudder because a number of people can look at the same sets of data and draw opposite conclusions.
Well, politicians.
Yeah. We're going to attempt tonight to share a lot of data that we see in the economy, both good and bad. And I'll let you draw your own conclusions. And that is to say, I don't have a crystal ball. I can't tell you exactly where we're headed. I have some thought of what some of this could mean, and I'll share that as we go along. But we're going to start looking back a little bit. And one of the things that for me right now that is encouraging is just thinking about stocks. And I want to just kind of briefly think about where the market's been over the last couple decades. So this chart goes back to 1996. I know the numbers may be a little difficult to see, but what we had from 1996 to about 2000 was 100% return in stocks, followed by a 49% decline in the bear market, followed by 100% return in stocks, followed by 57% decline in stocks previously. So it's really the last 2 economic cycles before this one was 2 steps forward, 1 step back. And then we kind of went on this really long 13 to 14 year bull market, and we saw a 400% rate of return in stocks. And so we took 4 steps forward, essentially in that time. The pandemic came, we took a few steps back, and then we quickly took a few steps forward. And so on January 3rd of this year, the market hit its all-time high. And since then, it's down a little bit. But when we look at this chart and where we've been going back to 1996, we still have made a lot of progress. And in fact, we're still generally ahead, for the most part, of where we were before the pandemic. So we certainly have taken a few steps backwards this year, but not necessarily at a percent or magnitude of what we've experienced in previous bear markets, although that line coming down looks awfully jagged down. So let's be done. What? It may not be done. It may not be done, exactly. But let's talk about stock valuations. This is a chart that I have liked for a very long time, and it makes a lot of sense to me, and I'll try to explain it to you. There are 3 lines horizontal across this. The middle line shows us the long-term average of stocks relative to their earnings. So we think the best way historically to value an individual stock is its earnings capability. How profitable is that company? And historically, and you can even go back even 80 years, and we would say that the S&P 500, which is the 500 biggest public companies in the United States, typically trade around 16 and a half times their earnings. And so that's a long-term average.
when the jagged line isn't the market, but it's really the relationship to the price of the stock to its earnings. And what we saw really going back since the pandemic is stocks got pretty overpriced. This top line, green line, is one standard deviation above the average, and then one standard deviation below the average is the bottom line. And when that gray line is in between those lines, we would say stocks are reasonably priced. It might be a little expensive, it might be a little cheap, but they're in a good place. And really coming into this year, at the beginning of this year, we were dramatically overpriced. The stock market had grown much faster than earnings had. And so that was really concerning. And so two things have happened this year. Earnings have held up. Companies are still generally profitable, and the market really has gone down. And so now for long-term investors, we're seeing a stock market that's reasonably valued. Now, what could change? Well, stocks could go further for earnings. And this is why I think the market continues to struggle this year, is that these companies have been profitable, continue to be profitable for the most part, but might not be next year. And because there's a concern, they might not be, the market runs out in front and says, oh my gosh, next year is going to be terrible, and they go down. We don't know that to be the case. We haven't seen evidence of this yet. And we just have recently gotten most of our third quarter earnings. And by and large, most companies are doing well. There's some notable exceptions in that, but we'll talk a little bit more about that. This is a really confusing scatter chart, but I tell us a few things. And again, I want to give you an idea of where we are from a historic perspective. On the left, as we think about these price earnings ratios, now we're at 16.4, so we're a little below the long-term average of where we say stocks are reasonably priced. And what this says is these dots represent the one-year return following any time that PE was at this place. And it's all over the place. It's really not a good pattern on the left. Anything can happen. But if we look at the average, stocks on average return about 8 or 9% a year following their placement where they are now. That's irrelevant as where we are in a cycle. But if we look over on the right, it's consolidating the 5-year return. So every time we're at this level of price earnings ratio, what happened over the next 5 years? We start to get a trend this way. And this trend would suggest that stocks probably over the next 5 years on average could average about 10% historically. So that's not a really bad trend line to be on. And that makes sense to me that we could see some reasonable returns over the next 5 years. We've seen a real big step backwards this year. And at some point in the next 5 years, I hope it's a lot sooner than that, markets will capitulate and go back. And so this chart would say historically, when we've been at this price point, the price earnings ratio, we've typically seen about an annual rate of return of 10% in 5 years following that. And so again, for long-term investors, I take a little bit of comfort of where we are. It is very painful for sure, but we want to think forward. This again, some busy data here, but I'll explain. When we think about stocks, I like to think about a tic-tac-toe board. There's 9 kinds of stocks. There's large companies, big companies, medium-sized companies, and small companies. And then we have value-oriented companies, we have blended, and we have growth. And blended companies represent that. So a good growth company would be probably Apple Computers or a lot of technology firms, where the purpose of owning that stock is I'm going to buy that stock, and I hope that it appreciates over the time that I own it. A value stock is more typically either I'm buying something that's maybe underpriced or something that is a profitable company. We see a lot of utilities as a value, where maybe they have a nice dividend, that the company's not looking to return huge growth to its shareholders, rather it's looking to return income and profitability to shareholders, which will help the value of the stock. And so we have all these categories, but what this still tells us in the upper left-hand corner is the 10-year average rate of return in these different 9 broad categories. And in all of them, for the most part, we still have a 10-year average rate of return as of last week. So this data was refreshed at the end of last week. We're still about 10% across the board, 10-year average rate of return in spite of what's happened this year. And if we go down to the bottom left chart, it's just showing how stocks done since February of 2020, so that moment before the pandemic kicked off. And again, we're seeing generally double-digit returns with the exception of smaller growth-oriented companies. They've really been hit hard. So now, if we look here at this middle chart on the top, we see, again, all categories of stocks are down by double digits this year. Our growth companies have suffered a lot more. Our value companies have suffered a lot less. That's no surprise. We know that oil companies and things like that have been, energy companies have done a bit better this year. And quite frankly, over the last decade, growth stocks really did a lot better than value stocks. We see that rotation changing. And we're starting to reflect that in our portfolios as well. We're having more a weight towards value stocks in general over growth stocks. It's really been the inverse of that for the last 10 years. So again, I like perspective. And so what we're looking at is going back to 1980, and we're looking at the return of the S&P 500 every year for the last really 42 years, I suppose. And the red dot is the 1 year was the lowest that the market got during a respective year. So every year here, I believe the market was negative at some point during the year, and dramatically so. And then what we saw is, you can see times where the market, was down 11, 19%, and still had a double-digit return on the year. Those are very volatile years there in the early 2000s. But and so again, if we look at the magnitude of this bear market compared to several of the others we've seen previously, it's really not that far out of whack. What I think burns or hurts so much is from a dollar standpoint, it's a lot more because we have a lot more money. On January 3rd of this year, we had more money than we ever had collectively, probably. And now we've seen the dollars collapse pretty dramatically. But we were down 25% at one point this year. And now we're right around down 20% on the year on average of stocks. So this year is not out of whack. But here's what I think has made this particular cycle painful and out of whack is this. So I just showed you the same chart for stocks. This is a chart for the Bloomberg Aggregate Bond Index, aggregate bonds. What you'll notice is this is the worst year out of the last 50, and you probably go back even further for bonds. So typically, when you have a diversified portfolio, whether you're aggressive or conservative, you still have stocks and bonds. And when the stock market was collapsing, your bonds always did something, or they didn't go anywhere. But you'll notice this has really been, the bonds on average are down 16% this year and had bottomed out at 17%. This has been the most challenging year. So, the part of the portfolio that historically has balanced us, even times like 2008, 2009, the part of the portfolio that has balanced us in the past has not helped. So that has probably magnified to some degree the loss in stocks. So even conservative investors have had nowhere to hide this year, and that's just that is a consequence. And we'll talk about this a little bit more where the Federal Reserve has been. Bonds and bond prices and interest rates have this inverse relationship. So as interest rates go up, bond prices come down. And we know that interest rates this year have risen faster than at any time in modern history. And that has put a lot of pressure on it. We'll talk a little bit more, and maybe I hope that we're closer to the bottom of the bond market than we might be, but we'll talk a little bit about what that means. Just on the left, I thought I would put this chart up here and just share with you a little bit of what would it take from today to get us back to where we were on January 3rd. If over the next 12 months, the market returned 27%, we'd be back to where we were. That's possible. We certainly, if we go back 2 slides, we've certainly had years where we've had that happen. And most notably, we've had returns like that coming out of significant downturns. So that's not out of the realm of possibility during a recovery. But if we could average 13.7% over 2 years, 9% over 3 years, all the way down to 6% over 5 years, would get us back to where we are. The point of this is, I told you earlier, maybe if we look to history as a guide, and if this is similar from a historic standpoint, we might average 10% a year over the next 5 years, and that would suggest we could be back to normal in 1 to 3 years potentially. It could be a lot sooner than that. It could take a lot longer. We just don't know. But what I thought too was helpful here is just a little bit of a historic. And again, I look to history as a guide to kind of put some perspective around where we are. Every one of these is different. There's no recession that's the same, right? But our typical expansion is 47 months. Now we were on the heel of one that was probably closer to 140, 150 months. And your typical recession is about 14 months. And so, if we are here at the, we have 10 months under our belt, on average, we would expect 4 more months of pain. Maybe it's a little less than that, maybe it's a little longer than that. So that's what we're seeing on the left is expansions for, and this goes back 100 years, by the way. So we're not just talking recent history, we're talking 100 years. Now on the right is we've plotted out time and we kind of length of recessions on the vertical axis, and on the horizontal axis is a timeline, and then magnitude of downturns. And so, of course, the Great Depression was the longest economic downturn and largest economic downturn in the last 100 years, and that's no surprise, I think, to anybody. Followed by, the financial crisis is here. And then this was the short-lived pandemic recession, which lasted just a few months in 2020. So again, we are not, we have not really, we look from a historic standpoint is that there's not a whole lot about this yet that's completely out of whack for us. And this is, again, on the left, we're kind of looking at our economic trend and what's kind of been the long-term trend. If we go back over the last couple decades, we've averaged about 2% growth in this country. Times we've had faster and slower. You can kind of see that here on that gray line. We were really coming back from at the beginning of this year. We're kind of getting back from the pandemic disruption of that trend line. And we're a little off of that now, but we're still there. But what's more important on this chart that I think is real, just to keep in mind, is where does GDP, that's all the economic activity in the United States, where does it come from? 68.4% this year so far is consumption. The rule of thumb is that 70% of our U.S. economy is driven by consumer spending. 70%, both mandatory and discretionary. So, things you have to buy, groceries, you have to buy clothing. But discretionary is the other part of that. So the biggest driver of our economy has been for a very long time the consumer. And so we do pay close attention to how healthy is the consumer. What does that mean? So again, a couple sectors here, just kind of see where we are. I'm not going to go into a whole lot of detail here, other than to say what you see in each of these charts is where each of these economic factors has been over the last 30 or 40 years, and then what the long-term average is. And what we're seeing is we're seeing an economy that's pretty close to its long-term average here. And so, we're not that far away from where we need to be as an economy. So, but shifting gears a little bit, and I know I feel like we're throwing a lot of data at you, but we're trying to really put together a puzzle for you today and look at the broader pictures here. And so I'm switching now to federal finances. And federal finances, on the left side is the total spending of the U.S. government, and on the right side is the sources of revenue. And so this chart looks a lot better than it did last year, but we will only have $1 trillion of deficit this year. Obviously, those deficits were higher the last 2 years. Say that somewhat tongue in cheek. And so on the upper right-hand corner, we look at every year going back to 1990, every deficit versus surplus. And we had a few years of surplus, as everybody will recall, in the late 90s. But essentially, since 2001, 2002, we've been deficit spending. And in some years, during the housing crisis, it got really bad, and certainly then during the pandemic, it got bad again. And then we're going forward. And then the bottom right is the federal debt. And what it's telling us right now is we're about 100% of GDP is our debt. And that's a place that a lot of people worry as we get far above 100% that things could get very challenging for our economy. And that trend, obviously, based on how we're going, is going to continue. I'm not here to make a political discussion, but I will point out just a few things on this chart that are very difficult, and no politician has figured this out yet. How to solve it, I should say, is, our Social Security tax and Medicare taxes are here. So that's our spending. I said that backwards. We spent this much on Social Security, 1.2 trillion, and 1.5 trillion on Medicare this year. Those are our outlays, and our income tied to social insurance is actually the green line. So this is the payroll taxes that fund Social Security and Medicare. And what you'll notice is we're bringing in about half of what we're spending on those social programs. And so the rest of that has to come from somewhere. And then we have defense in here. And so even this chunk right here, the margins are really up here, the little bit of non-discretionary defense spending. And And so it's going to be a very challenging puzzle for any Congress, regardless of politics, to figure this out and to get, to lower deficits. The other thing that's not in here, that's in here, but has been insignificant, but is going to change, is the interest on our debt. We don't pay a lot of interest on our debt. We've been borrowing at 0% interest, roughly speaking. The 10-year treasury is the way the government issues treasuries to borrow money, and they would put a treasury for sale at 3% and charge a 2% premium. People are willing to pay it. Our debt is going to get more expensive for us. And so this little dark blue slice will start to eat up more. And so those are things that are headwinds on the horizon that we really need to be paying attention to. And I wish I had a good solution, but I don't. But let's switch gears a little bit, because I think this is where I have a little more optimism, as we'll talk about the individual consumer. Again, we think the consumer is important because 70% of the U.S. economy, roughly speaking, is driven by consumer spending. So what we're looking on the left is all of us together, every one of us Americans added up together, our balance sheet, we have about 162 trillion amongst us. And our debt is about 18 trillion. So assets versus debt, and most of that debt is mortgages against our homes. So this is not a really bad looking balance sheet. And up in the right hand corner is the debt service ratio for the average American household. And one of the things you'll notice is from 2010 on, about 10% of income went to debt service in this country. And now, since the pandemic, we've really dropped below that. Now we're back up a little bit, but we really are historically low debt service ratios right now. And I think that's really encouraging. We obviously don't want to see consumers get into a lot of debt, but I'll draw your attention to the bottom right-hand chart and this is personal savings. And what happened during the pandemic is people saved a lot of money. We couldn't go anywhere. The government was sending us money in a lot of cases. We had all these different things going on, so people saved a lot of money. Now we're seeing people dip into their savings in that bottom right hand, but the consumer still is resilient. And so we're still spending money. The consumer spending reports we're getting are still reasonable. People are starting to pull back a little, but not very much. What they're doing is spending their savings that they accumulated the last few years. A lot of the big banks that issue credit cards watch consumer spending very quickly. There's some sort of consensus that says the American consumer can probably continue to reach into its savings and spend a little bit of a deficit probably here for the next 8 months or so, probably until next summer, sometime 8 or 9 months. And that's where we think consumer behavior may dramatically change. And that's where the risk of recession, I think, also increases because, again, 70% of our economy is based on consumer spending. People lose their job, or they stop spending, or they run out of savings to spend, or they drive their debt higher. That spending will go down, and that could have a pretty dramatic impact on the economy. But right now, we're holding our own. So I think if the Fed can get things under control in the next 6 to 8 months, there's probably the idea of a soft landing is still possible, but that's something just to pay attention to. So I think that's one of the concerns that people have. There are those out there that'll tell you, oh, we're headed to a big recession and consumers are going to stop spending. Maybe, but they haven't yet. And here's part of the story on why that is. Unemployment remains really low. Wage growth is slowing down a little bit. And so this chart would seem to indicate that the labor market is starting to soften a little, but it's still pretty strong. That gray line across the middle there is the 50-year average unemployment rate in the United States at 6.2%. And right now we're below 4% unemployment. So we are fully employed. And so consumers have jobs, they make money, they have money to spend. Obviously, if interest rates go up, we could start to see things change. We're starting to see stories creep into the news. A lot of the big tech companies, Amazon is not hiring any more corporate employees. They'll hire people to work in their warehouses and drive their trucks. They're not hiring anybody to work at corporate. And you're seeing that. I think Microsoft made some announcements. So some really big companies are starting to freeze their hiring. So that's one sign that the labor market is starting to soften. But at the moment, it's still very strong historically. Wage growth is there, although it's starting to settle down a little bit as well. So inflation. This has been the story, obviously, this year, and I think that's what's been driving our economic malaise more than anything else. It's the inflation and the concern that inflation will cause a recession, or the Fed will raise rates to combat inflation too much that will also cause a recession, which probably neither of those scenarios are ideal. What we keep hearing is this idea of a soft landing. It's still too soon to know if they're going to be able to do that. We're not sure. Yesterday, just as an update to this, the Fed did announce that it was going to raise the interest rates 0.75 points. That was no surprise. The market was all over the place yesterday. The Fed released a statement that we're raising 0.75 points, and we're going to be thinking differently about this. We might be revisiting how aggressive we're going to be with rate increases. And so the market shot up right after the announcement at 2 o'clock yesterday. I thought, okay, yeah, this is where we need to be. Maybe in December they'll not raise as much and so on. And then Jerome Powell came out to the press conference and got asked, and struck a much different tone if anybody was paying attention, and it's okay if you weren't. But basically said we're going to continue to be very aggressive, and yes, we will lower the rates once we see that inflation is well under control, and we don't see that at all yet. So that was a little concerning. But again, I want to talk a little bit here in the next few slides about what we're looking at, because I think it is possible that we could be getting to a certain place sooner rather than later, a better place with inflation. So the blue line is headline inflation. That's everything, the cost of everything, and how much it's increased year over year. So, we've been around that. We hit that 9%, meaning, if you look back 12%, things that have improved 9% or gone up by 9%. Now, core inflation is the gray line, strips out food and energy. Those are the two most volatile components. And so you have to look at both. Now, it's kind of silly to not look at food and energy because we spend so much of our money on it, but just to kind of see where we're at. And if we look at that gray line, we can see really we have not made any improvement on everything else. So energy prices did come down a little bit over the summer. Gas prices are lower now. We're only at $4 a gallon as opposed to $5. But again, where we're at is that we haven't really started to see other prices curtail. But let's pick that apart just a little bit. And I want to look at this chart, and what we're looking at is what makes up inflation. And so it may be hard to read, and so this is, I believe, a month by month over the last 12 months, a snapshot of what were the components of inflation. The green bar is energy. So you can see how the green bar, if we look back a year ago, was smaller, and then it got bigger, and it's gotten smaller again. So we've seen energy prices go up, come back down a little bit. The red is new and used vehicles. We saw new and used vehicles go way up, probably 6-7 months ago, and now they started to come back down. So the green and red categories are starting to improve. What's next? Food at home. That's groceries that we buy. That has gone up, but it's kind of leveled off. But it's still food's more expensive than it was certainly a year ago. But it doesn't seem to be increasing at the rate it was. Then the next is other. And this is home furnishings, apparel, education, communication services, medical services, and so on. That has gotten a little bit bigger, but it's still pretty level. And then blue is restaurant, hotels, transportation. This is travel and leisure. That has gone up a good bit because people are traveling again. There was an expectation. But let's talk about this last category, this dark blue across, that has just consistently gone up every month for the last year, and that is shelter. Those are housing costs. And what's interesting is that as interest rates are going up, the housing market takes almost a year to catch up to that. And so one of the biggest things driving inflation right now, in my opinion, is housing costs. And we're already seeing the home mortgages at around 7%. That is not a lot of buyers out of the market. The problem is it's not reflected here. So real estate prices really haven't settled down yet, and they take about a year to settle down. So I would expect it would be next spring, which is where we'll be at that 1 year mark of the Fed starting to raise interest rates, because they started the spring of this year in March. I think that's where we might start to see that number improve. So I think it's maybe, the Fed is being very aggressive with their interest rate hikes, but we may start to see it in the first half of next year, some relief as this sector in particular starts to settle down. But you can see it was under 1% a year ago, and it's now over 2% now. So it's going to take a little bit of time for the interest rates to have an impact on that. So I thought we'd take a quick joke, and I'd ask this question. It says, why does the Norwegian Navy put barcodes on the sides of all its ships?
Anyone? So when the ships come back to port, they can Scandinavian. I recognize that this data can get a little, this data can get a little dry, so I wanted to just insert a little bit of humor. I love a good dad joke, if you can't tell. And some of it, what I love most is telling it and listening to the groans. So here's the Fed and interest rates, and just a couple things. Obviously, we're seeing a very steep rising of rates. They went up again this week, so we're almost at 4%, I guess. And the consensus estimate continues to be, and when I say consensus, the Fed believes it'll be one place, and the market believes it. They're very much aligned right now, and they believe that sometime in the next year we'll cap out at 4.6%. Now, we could hit that by the end of this year, the rate we're going, but if we have another aggressive hike in December, there's one more Fed interest rate action in December. So a couple things, going back to the bond market, remember I said, when interest rates go up, that just kills bonds. The bond market has priced in where the Fed thinks it's going to be and where the market thinks it's going to be. So if the rates kind of stay on this schedule and we see, maybe we see a quarter of a point or half a point in December and maybe a quarter of a point in the beginning, excuse me, of 2023, then that would be in line with where we are. And that would seem to indicate that if the Fed can get to that level, that the bond market probably will start its recovery. And keep in mind, bonds will be yielding more and so on. But if the Fed gets much more aggressive, then we could still experience some pain in bonds too. Now, our counter to that is we're very short duration. We'll talk a little bit about that here in a moment, what that looks like. So we'll talk about the Fed balance sheet. So there's really two ways the Fed can tighten things up. The first is we know they're raising interest rates. The other thing is the Fed has balance sheet. So what happened really significantly following the 2009 and 2008 financial crisis? The Fed lowered rates to zero, but said, how can we put more liquidity in the system? Well, we're going to buy bonds. So the Fed started buying bonds, which drove bond prices up and yields down. It's the opposite of what's happening. So the Fed started, raising rates this year, which is painful, but the Fed is now unwinding its balance sheet. It's not selling bonds. It's and they own mostly treasuries and mortgage-backed securities, as you can see there, or maybe you can't, but so they own U.S. treasuries. And as those treasuries are maturing, they're basically taking that money out of the system. So, they have a U.S. treasury that matures, and the Fed, because it controls all the money, just doesn't put that money back in the financial system, so that those bonds kind of mature and poof, the Fed just kind of, takes it off the balance sheet. And so that is also a tightening action. So those two things together, certainly making the cost of capital more expensive, and certainly are intended to slow and be deflationary and slow the rate of inflation. And so we will see. So this is the other thing that the Fed is doing right now, to try to get the inflation rate of CPI down. And again, thinking about, so what we're looking at is the 10-year Treasury. And I think the 10-year Treasury is an important thing to watch. It drives so much in the marketplace. So the 10-year Treasury, banks look to the 10-year Treasury rate to determine what they're going to charge for mortgages. They look to the 10-year Treasury rate to decide what they're going to pay in interest in their bank accounts and CDs. There's a lot in the financials, and even Thrive and other insurance companies decide what they're able to do in their general account reserves, and what kind of interest rates and products and premiums they can offer their consumers based on 10-year treasuries. So this drives an awful lot in the economy. And what we're looking at, the blue is the actual treasury yields. And so going back to 1981, treasury yields peaked at 15.84%. Of course, they've been down really for the last 4 decades, but we're back up to 4% as of last week on the 10-year. And the gray line is simply taking the 10-year Treasury and subtracting the inflation rate. And so if you're holding 10-year Treasuries, which are generally some of the safest investments you can own,
because it's, backed by the full faith and credit of the United States government, which has been the strongest economy in the world. And besides, they can just print money. What you'll notice is people are really, to hold 10-year treasuries still to this day, you're losing real dollars. Now, it's a little disingenuous to say, well, you're really losing money in a 10-year treasury because you're only making 4% at a time when stocks are down 20%. But you get the idea that it's been a pretty difficult time, and for really the last 10 years, people have been willing to accept no or almost negative rates of return against their inflation, to hold U.S. Treasuries. So that's an interesting trend there that we keep an eye on. So thinking a little bit about bonds, I want to just share a little bit of what we're looking at here. And this is going to be very hard to read, so I will just kind of guide you through it. On the top left are Treasury yields and returns year to date. So the 2-year Treasury is the best year because it's short duration. It's down 4.68%. 30-year Treasuries are down almost 37%, or excuse me, almost 36% year to date. So those longer durations have been very difficult. And then you can see all across the board here, all the different categories of bonds, and they're all negative. Very few have done, there's no place in the bond market that has made money this year. Now, to combat that, we tend to be very short duration. So those are our instruments that mature really quickly, which you typically don't get as earned in a rising interest rate environment. So which is why the 2-year is only down 4.6 to the 30-year being down almost 36%. And that's just explaining to you what's happening. If we look at the right, what we're seeing is what happens if rates go up 1% or down 1%. And so what we're seeing there is, now interest rates were to go up or to go down 1%, we'd expect the 30-year Treasury to do very, very well. And so again, as interest rates went down and stayed down over the last decade or two, bonds did really well. I mean, they were really encouraging asset class, but this has been a very challenging year for bonds. But I think, again, when we look at this chart, we think that most of the pain is probably behind us in bonds. I wish I could say the same for stocks. Maybe, but we just don't know. This is our yield curve, and it's basically all the different charted out. And again, this is where we were at the beginning of the year or end of last year and where we are today. These are all the different ranges of U.S. Treasury durations here and their rates here. And when the shorter rates are better than the intermediate or long-term rates, we have what's called an inverted yield curve. So this is, again, this is a normal yield curve where it kind of arcs upward, but if it goes up and then comes back down, that's considered inverted. And the reason that's important is every recession we've had, the yield curve has inverted before. Now, every time the yield curve inverts doesn't mean a recession. The yield curve has inverted more times than we've had recessions, but we've never had a recession where we didn't have this. And what that typically suggests is there's a mismatch of capital. And so that's it's a little bit of a canary in the coal mine for us, but we're certainly seeing this inversion right now. And so again, that has people and the market on edge a little bit. Is it a definitive signal for recession? No, but it's certainly one of them. Again, just thinking about, I put this in real quick here, thinking about state and local debts. What's interesting is on the far right chart, we see the federal debt is up at 99% of GDP. We've actually seen state and local debt come up and drop down a little bit. But I have to chuckle a little because what happened is the federal government gave a lot of money to states and local, so their debts actually went down. So we just took debt from here and put it up here. It's all our debt anyway. We're all the ones that have to pay tax on it someday or figure out how to pay it back. But, that's a little what's going on. And then I want to talk a little bit, we're getting near the end here, and I just want to share a little bit of, we think about international stocks. And so the purple charts or purple lines and spikes you're seeing are at times where international markets have outperformed, and gray is where U.S. Has outperformed international. Right now, we are still very much in a U.S. outperformance mode. The purple is the Euro Australia Far East Index. So it's all the other developing countries essentially around the world. In Far East would be Japan and South Korea, and then in Australia. But you know, the US market has been dominant for the last 15 years, and it's certainly appearing that it will continue to be dominant. And so we're having more certainly weight to US stocks over international right now for that. And again, I won't, this chart gets a little busy and headachy for me, but again, would still seem to suggest that the US is in a much stronger position economically, particularly than what's seeing in Europe. Great Britain's in a recession. A lot of Europe is falling into recession, and they've got some issues ahead of them. We know that energy is going to be a very difficult set of math for them this year yet, and so you know, it's could be worse, I guess. Thinking global inflation real quickly here, we're just looking at you know, the biggest developed countries over here and emerging countries, and what you're seeing across the board here is blue is good, red is bad, and so we're seeing really high inflation across the world. The one exception, and I'll laugh a little bit, is China and Indonesia don't appear to have high inflation. Though, just say a word, a note about China, and we have another slide on it. But our chief investment officer had shared with us, you know, when we at Thrivent, we think about the GDP growth in our big economy. We came out last week. So the middle of last week, we came out and said our economic growth in the third quarter of the United States was 2.6%, which is a little surprising. It was good. It was good. It was actually good news. It was good news last week, and that's part of the reason we saw the market do well in the last couple of days leading up to yesterday. And then next month we'll revise that number again, and then this month at the end of November we'll revise that number, and then in December we'll revise it a third time. So when we report our economic data, we revise and revise. It's just so much math. There's so many things to count when you do this. What I love about China is on about the 10th day of the next quarter, they'll say our economic growth was 7%. And never to be changed, never to be modified, which tells me they're making it up. We said we were going to grow 8%. We grew 8.1. So I give you that little bit of snapshot into China, which is very, you know, it's not a capitalistic society. The government controls everything, and what the GDP is what they say it's going to be. But let's keep that in mind as we look here. I reversed slides in my brain here a little bit. But what we're looking at here is input and output prices for supply chain stuff. We're starting to see supply chains delivery time get improved, and so what this is suggesting is that the PMI, which is the manufacturers index, is improving. So supply chains are getting better, and input output prices are starting to get some relief. So this is a good one. Of the things that's been troubling for inflation is that supply chain issues. You know, you couldn't get enough computer chips to build cars, and so guess what? There's only so many cars to sell. So guess what? We can sell more cars. So when we limit supply, and there's still a lot of demand, we can raise prices. So that's been one of the contributions to inflation, has been a lot of supply chain logistics, and so we're starting to see that stuff get fixed. Word about China. So you heard my China story just a moment ago, and when we come across here, here's been kind of their GDP over the last 15 years. And isn't it interesting that they're starting to tell us that their GDP growth is very, very poor? So I don't know how much you can trust numbers, but you know, from China, because I think some of it's politically motivated and made up, but the fact that China is starting to really show that things are softening there is very interesting, and I'll be curious of what that means for them. I think they're going through stuff right now similar to what we went through in 08 and 09 with their real estate markets, and so they have a lot of mismatch in that, and I think that's going to be very difficult for them to unwind. So the only place that you could have made money this year, besides, well, the only place we could have really made money this year is in commodities. And so just kind of thinking about that now, the 10-year average of commodities is still generally negative. So it's an asset class that's incredibly volatile and in general and done well. So if you look here, you can see year to date, energy and grain prices are still positive on the year. But a lot of other commodities have turned negative on the year. And since this middle of the year, June 9th, we've seen all commodity prices drop with the exception of cattle and pigs. Again, there was this asset class of commodities this year that looked very attractive when stocks and bonds are getting beat up. And now this also has been a very volatile and difficult place to make money this year, even though there's some parts of this market that have done well year to date. So as we wrap up here, just a couple of key reminders, and that's thinking about diversification. So if we look back over the last 20 years, the best year in the market, we made 47%. The worst year, we lost 39%. In bonds, the best year, we made 43%. The worst year, we lost 8%. This year, we'll replace that. But a 50-50 portfolio, a blended, diversified portfolio, 50% stock, 50% bonds, had a best case return of 33, the worst case return of 15% historically in 1 year. If we look at a 5-year rolling average, we've never lost money in a diversified portfolio, 10 years and 20 years. The point is time removes risk. And so when we are managing money for our clients, we really think about timeline. We want to be long-term. We don't want to take risk with money that we need to use tomorrow. It just doesn't make sense. Sure, we could get rich quick, but we can also get poor quick. But long-term disciplined growth is good. And just present it a little bit differently. We look at a bunch of asset classes and how they've returned here over the last 20 years. Stocks still have, or excuse me, 10 years. I said that wrong. Stocks have still averaged 16% over the last 10 years, all the way down to. And then we have a 60-40 portfolio still has averaged 11.1%. The average investor is this orange line here, and this is a data collected from people who make their own investment decisions in their 401k. And the average investor we know tends to jump in and out more often than just keeping that disciplined, diversified strategy. And so just by being disciplined, sticking to your 60-40 or whatever mix is most appropriate to you, can add 2 or 3% just on top of what can happen. So the power of diversification. The last few slides, and I'll encourage you to log in and watch it and fast forward to the end of this presentation to read through all these. These are definitions of all the different indices that we use in the presentation. I've tried to explain what those are as we go along so that you don't need to stop and read this carefully because it's a lot. We're really grateful to JP Morgan. They're one of our fund partners. They provide us up-to-date data on a daily basis, and so it makes us preparing for these presentations very easily. That's why you see JP Morgan's logo in this presentation. But also the Thrive and Advisor Network also provides us resources as well. But again, these are materials presented, our opinions provided by a third party. And again, past performance is not indicative of future results. So that wraps up the presentation part. I'm just going to